This short tutorial introduces a number of techniques for investment appraisal. The next investment appraisal technique we consider is the net present value. The techniques of payback and accounting rate of return do not consider the time value of money. Because of interest rates and inflation, a cash flow in the future may not be worth as much as the same cash flow today. The present value of a future cash flow indicates how much money would have to be invested now at a given rate of return to yield the future cash flow. We can calculate the present value of a future cash flow by using this formula. We can use the formula to calculate the present value of $1 at 10% in 1 year's time. Replacing the values in the formula, we can calculate that the present value of $1 at 10% in 1 year's time is 90.9 cents. That is, if you invest 90.9 cents at 10% for 1 year, it would grow to $1. The net present value of a project is the sum of the present values of all cash inflows minus the sum of the present values of all cash outflows. A company is evaluating a project with an expected life of 3 years and an investment outlay of $1 million. The opportunity cost of capital for the project is 10%. The estimated cash inflows for the project are as follows. Year 1 is $300,000, Year 2, $1 million, and Year 3, $400,000. To calculate the net present value of this project, first discount the future cash flows by the appropriate discount factor at the opportunity cost of capital of the project. This cost of capital is 10%. These discount factors can be calculated from the formula. This discounting provides the value in present value terms of each future cash flow. The overall present value of the project is calculated by adding the present values of all the future cash flows. We then compare the present value of the future cash flows with the initial outlay of $1 million to arrive at the net present value of the project. As the net present value of the project is positive, we can say that the project adds to shareholder value. Thus, from a financial perspective, the project should proceed. The next investment appraisal technique we consider is the internal rate of return. The IRR is the maximum cost of capital that can be applied to finance a project without causing harm to the shareholders. As we increase the discount rate, the NPV of the project reduces. This is because future cash flows are discounted to present value at a higher rate. At some value of discount, the NPV of the project will equal 0. The discount rate at which the project NPV is 0 is referred to as the IRR, or internal rate of return. The next investment appraisal technique we consider is the Profitability Index. In the case where a company has a number of alternative projects and has limited resources to invest, the company must rank the projects in relation to their potential profitability. The resource that is limited is investment funds. Thus, the company should aim to maximize the present value of projects with respect to the limiting factor of investment funds. The method is to divide the present value of the project by the initial cost of the project. As an example, consider that a company operating under the constraint of capital rationing has identified 7 independent investments from which to choose. The company has $20 million available for capital investment during the current period. Which project should the company choose? To maximize the net present value to the organization, projects should be pursued according to their Profitability Index ranking. The project with the highest Profitability Index is Project C. This project represents the best return on the capital employed by the company. This project should be prioritized. This project requires an investment of $5 million, leaving $15 million of the $20 million remaining to invest. Project A is ranked at number 2. This project requires an investment of $2.5 million, leaving $12.5 million remaining to invest. Project D is ranked at number 3. This project requires an investment of $10 million, leaving $2.5 million remaining to invest. Project F is ranked at number 4. This project requires an investment of the remaining $2.5 million. If the company pursues Project C, A, D, and F, this provides a net present value of $6.175 million on the $20 million invested. This short tutorial introduces a number of techniques for investment appraisal.